Hello, everybody, and welcome to another episode of the Investing with IBD podcast. It's your host, Justin Nielsen here, and I am back from vacation in Costa Rica. Glad to be back and glad to be with Arusha Paris, who joins me every week. He is an O'Neill Global Advisors portfolio manager and research analyst. How you doing, Arusha?
I'm doing well, Justin. It's good to have you back. It's nice to see producer Mike happy that the actual recording software is starting to work.
Yeah, there were a couple false starts, but and it's tough, right? I was going to start making the same joke over and over, but I just wasn't sure if you would smile at it anymore. And if you're not smiling, I mean, what's the point? Well, we've got a great show for you. It is June 26, 2024 on a Wednesday that we're taping this, and we're bringing back to the show John Kosar, who has been on the show a number of times. He is the chief market strategist over at Asbury Research. He's got some really interesting models that we like going over. It's amazing to me how he attacks it from a little bit of a different way, but a lot of times our signals really match up very nicely. So, John, welcome back to the show. How are you?
I'm great. It's good to be here. It's good to see everything seems to be clicking, and looking forward to it.
Yeah, so we got our producer in the background doing some cheers, which is always a plus. It's good to have cheerleaders in your corner. So
it's the first time he's cheered us on too.
I know, first time he has cheered us on. Usually it's like he's like, "Come on, guys,
shaking
cut this." He brings out the hook on the stage and everything like that. So it's a nice change of pace. But speaking of change of pace, John, we've been having a lot of changes of pace in the market. So really excited to kind of get your thoughts on this. Why don't we go ahead and dive right in? We're going to talk about the market. We're going to talk about rotations and how quick they're happening. And then you've got a few stocks and ETFs that you're going to kind of share with us your thoughts on. But let's start with the market in general. And you've got an S&P 500 chart. I should mention John Kosar he's got those special 3 letters behind his name, just like Arusha does, the CMT. So a lot of great chart information that he goes over. Give us your thoughts on the S&P 500 right now and how it's looking.
The S&P 500 has held up really well. There's a chart there that we can go to if you like, but the trend is up. It's up above the moving averages. There are some support levels underneath the market. They're very visible. They have to do with the trend line from the October lows. They have to do with the 50-day moving average. But the chart is it doesn't tell the whole story. I mean, if all you looked at was the S&P 500, you think, man, this is a comfortable market. This is a normal, healthy bull market, and it's really not. That strength that we're seeing in the S&P 500 is driven just by just a few stocks. My son Jack, who works with us, just the other day, we're just kind of breaking it down. The S&P 500 was up 14% for the year as of a couple of days ago. NVIDIA was responsible for 5% of that. The next 5 down in market cap were responsible for another 5% of that. And the remaining 4% was the other 494 stocks. So, that's the poster child for what's going on here. Here, we'll look at that chart here. Let's look at those levels. If you're trading this, you want to know where the big levels are, right? So you want to try to stay with the trend as much as possible. So we've got some minor support here at 53.42. That's just off of the May 23 high. But the level that is the most meaningful to me, I think it's about 4% below the market. 52.90 is this trend line that originates back in October. That's where this latest leg up started. Our CPM model came in right on November 3rd. So we were a couple of days after that. But
that's so John, maybe explain what CPM, or just at least what CPM stands for.
Correction Protection Model. And the reason for the model, the genesis of the model is the financial crisis. During the financial crisis, we work with a lot of RIAs. We work with a lot of individual investors as well. But what happened in the financial crisis is there were a lot of folks that stayed too long. And they stayed within months of the bottom. Finally couldn't stand the pain anymore, got out. If the market bottomed, we had that kind of secondary bottom in March of 08, and then the market really took off like a shot. A lot of people were gun shy to get back in after taking that kind of a beating. And once you let your emotions start dictating how you trade, you're dead, as far as I'm concerned.
Absolutely.
So the CPM is just trying to get us out of the market or letting us know when the market's going into a weakened phase. It's not focusing on what the S&P 500 is doing every day. It's looking at a lot of market internals, a lot of our own tools. When the market is internally weak, we move out of the way. When the market starts to strengthen internally, then we move back. So the CPM has effectively been risk on since November the 3rd. So what we would look at is if CPM moved to risk off and we broke down through this 5290 to 5252 level that we just were seeing just a couple of minutes ago, that's the signal for us that at least on a tactical basis, it's time to do what you normally do when the market's going against you. If you're a manager, you might be shifting to different assets or maybe reducing your allocations. If you're individual, you may go into cash, you may go into bonds, some kind of short-term bond. But that's the most important level, I think, for folks that are watching this video to focus on. Through this 5290 to 5250 area, we are the trend has changed in terms of the minor trend. Major support is down here at 48.56 to 48.19. That's about 12 to 14% below where the market is right now. And the takeaway from that is we can drop 12% from here and still be in a major bull market.
Right.
So bigger picture, if we do have a correction, which I think is likely between now and I don't like to forecast anymore. I've been doing this for 40 some years. I just watch the data. But if we have a correction, it's great to know where these bigger levels are because that's when you can make your year, is being able to allocate money that you had on the sidelines at these places that are support levels. That's where your risk reward is good. And that's a secret to trading. Everybody knows the market goes up most of the time, but putting your trades on at these advantageous levels is really a lot of the game.
Yeah. So you know what? Let's go ahead and also kind of take a look at the relative performance versus a few different things. You have a number of ways of looking at the S&P 500 versus the S&P 500 growth. So talk a little bit about different ways that you kind of do comparisons of that relative strength.
Sure. Relative performance, the longer I do this, the more relative performance becomes important to me. In some cases, I think it's more important than just staring at the S&P all day when it's up 50 today and down 50 tomorrow. I want to see how it's performing against other major assets. So what we have down here is SPY versus AG, and AG is the broad bond index. I believe it's an iShares product. But the takeaway here, and we have a 21-day moving average under the relative performance daily of SPY versus AGG. 21 days is because that's the tactical time period that we use here at Asbury Research. And you could see when stocks are outperforming bonds per SPY AG, you have a nice move higher in the S&P 500. We had a little stutter step here, right? Middle of April to the beginning of May. That caught this, but then it quickly re-engaged on May the 3rd. And it's continued to outperform. And you could even see, look back towards the first third of the chart. When this relative performance line came and tested the 21-day on January 30th, that was a really good low-risk place to get back into the market if you weren't there already. And then we had another one here on the 30th. The market had a couple of weekdays, maybe a week or something like that. So I was watching this, in another 20 charts, but this was one of the ones I was focusing on because it was a logical bet for me that as long as this relative outperformance trend stayed intact, this was a great place to add to my long position here because the risk reward was so good.
Yep.
Yeah.
So John, so going back to the narrowness of the market, right? Because it is very narrow. Now, for individual investors, the way I look at it, especially for a lot of our listeners out there who are individual investors, and when I see if it's narrow, I just stick with the trend, go with where what's working, right? And of course, manage your risk, and then get out when some of those are breaking. But for institutional investors who need to be in a lot of different stocks, who are judged against a benchmark or something, how do they handle this type of environment? Because it's much more tricky when you have to kind of spread out and diversify.
really tricky. That's what I was saying. If you're just somebody that looks at a chart of the S&P 500, it looks like nirvana. It looks like everything is great. But we track 85 ETFs. They include commodities, industry groups, and sectors. And we look at 4 things. We look at the major trend. It has to be up in order for us to recommend those as an overweight. It has to be outperforming the S&P 500 on a quarterly basis. AUM has to be expanding on a monthly basis. And then we've got some tools we use to determine if there's a good risk reward on the idea. Of those 83 or 85, I think there was only 3 or 4 that were outperforming the S&P 500 on a 63-day basis. So that shrinks that pool that you could look for outperformance. Right. The 2 that we've been looking at and that have been doing well are just very simple. It's been growth and it's been large cap. So there has been a little bit of relative outperformance to gain there. But otherwise, if we're looking at sectors, even sector-wise, there's only 2 sectors of the S&P, and we look at the spider ETFs. There's only 2 of those sectors that have outperformed the S&P for the year. It's been XLK, technology, XLC, communication services, and XLK outperforming by about 4%. 2.5% of that came last week. And then XLC is maybe 1.9%. So there just hasn't been a lot of opportunities to find outperformance because the market is so narrow. We've got those 5 or 6 stocks that have been the show this year.
Yeah.
Well, I also have this SPLG comparison and SPTM. Maybe we could go over to that chart
Sure.
real quick, if that's okay, and you could chat a little bit about what you're seeing there, kind of to that effect.
Yeah, that's why I want to look at these, because we're looking for outperformance wherever we can find it. There used to be some outperformance a couple of months ago. Some of the overseas markets were outperforming. That all dried up. The only overseas market right now of the 25 that we track that's outperforming is Taiwan. And Taiwan is, it's related to AI. That's where a lot of the production of AI is. But this chart, we have large cap here up on top. Down on the bottom, we have large cap. SPLG is the 500, the S&P 500. SPTM is the ETF for the 1500. So what we see is, and we use the 63-day moving average here on the lower part of the chart. That's our strategic time period, right? So that's a quarter. That's a business quarter. You can see really since January, this has not been trending. It's been drifting sideways, but we did have a breakout of this sideways. It's called a rectangle if you're following charts in that way, looking at patterns. So this looks like a lot of outperformance here, but this is really only 1 or 2%. But that's been one of the places that we have been telling our clients, our subscribers, we manage money and we also sell research. But this is one of the places that we've been able to squeeze out a little bit of relative performance. There just hasn't been a lot of opportunities like that.
And then, since we're, kind of here, maybe you could chat a little bit about the growth story.
This is almost the same chart, right? So this is growth. This is SPY-G versus SPY. And you can see since January, right, no trend, right? There's not a whole lot going on here. But once we broke out of this rectangular pattern here, this was May 23rd. This was on one day either side of what we just looked at when we were looking at large cap. So we've had about, 2.5% relative outperformance here. So this has been another place where we have identified that, you could put some money to work here and maybe be able to squeeze out a little bit of relative outperformance. So those are 2 places lately that we found that there's been a little bit of alpha to be able to capture.
Justin, do you remember where we got the fall through day? I'm trying to line up where we got. No, the most recent one after the 6 week.
Yeah, phase. Yeah. So in May.
So is it around the same time, or maybe just a little?
Yeah. So it was a little strange because the volume the volume was really kind of weird at that point and kind of giving mixed signals. Remember, we also had, not too long ago where, the meme stocks were going crazy.
That's
and
right. Yeah.
they were kind of distorting volume in a big way. But we had what we've been calling the follow through day in spirit on May 3rd.
Okay.
And so that was kind of just as we were coming up. And then, I think the real one was like a week later. But you had some really strong days, May 3rd, May 6th. And then you finally kind of broke out, kind of what he's showing right there.
Yeah.
Maybe a little bit earlier, as you broke
Pretty
out of that
close.
vector.
Yeah. Yeah, because it is really interesting, John, to see. I would have thought that there would have been more outperformance from both of these, right? But I guess it took some time to consolidate. So looking at both of these charts, it is kind of impressive that it's only been a month or so you're seeing this kind of outperformance versus the overall market.
And the interesting about these charts, if you look at this chart, it looks like we had a really big move right here from
exactly.
The end of May. But it looks big because this is so tight here in between the middle part of January up until the middle part of May. That range, the relative performance range, it was just kind of winding up like a spring. So you look at this and you say, man, I'll bet you made a lot of money. Well, no, it's only like 1% or 2%. It's very small. So it's kind of like trying to squeeze some water out of a stone. There's once you move away from those big names that are up at the top of the market cap, it's like slim pickings for looking for relative performance, and that's including bonds. It's including a lot of the commodity markets, almost all the commodity markets. It's including overseas. The game right now is those top 5 names. That's it.
And how similar is it to the beginning of 2023? Because it's almost like deja vu. It feels like how similar were some of these charts that you saw in 2023 versus now?
It's different. I don't remember specifically, but I do know that I can't remember and I'm sure there was one. I've been doing this for a long time, but I can't remember a period where it was this narrow. Not only just looking inside the S&P or looking inside the U.S. equity market, but, looking at other assets, looking at commodities or looking at bonds or looking at overseas markets. It's just been, I don't recall working so hard to find so many few opportunities that are outperforming.
Yeah. I mean, sometimes, my recollection is, especially in an uptrending market, right? I mean, you expect there to be nothing in a bear market, right? It's slim pickings. But when the indexes are moving up, there are times kind of like when you get to the end of a cycle where I feel like you get some narrowing. You start seeing things breaking down, and then there's just a few that are still kind of making the indexes go higher, but it just doesn't last. So you kind of get the signals a lot of times in the individual stocks. And then the markets start kind of following as well. But yeah, it's very different from coming out of a bear market when you kind of expect, oh, okay, now we're getting our traction to have it this narrow.
This is very unusual in how it happened. The end of December, the beginning of January, our internal metrics all started to show the market was tired. It was starting to turn over. On January the 8th, and I had to look backwards to find this, but I saw there was a lot of breakouts on Jan 8th, Jan 9th, and Jan 10th. There was, in Las Vegas, there was a convention for AI. And NVIDIA announced some new products, and I believe there was other firms too. But if you look at a chart of NVIDIA and you look at the 8th, it broke out of this, NVIDIA had been drifting sideways for 6 months. And it had this enormous breakout, and I think it's rallied, was it 50,
yeah,
60,
I mean, it's up like 100%
since then. And that was the genesis of this, is the market was set up to do what it normally does in January and February, right? Take a breath, have a little backpedaling. And this event on Jan 8 seemed to be the catalyst for all this. Just there's nothing we can do to make money with that now, but I actually kind of saw this, everything was pointing towards this date. So I just started pouring through the internet and seeing what happened. And that was the only thing that I found that was a game changer.
So before we end this segment, I wanted you to just kind of go through your Asbury 6, and you've been on the show enough times. A lot of our listeners are going to be familiar with it, but we've got new folks too. So just to kind of let them know, it's not all, it's not all about the chart, right? You're looking at a few different things, and it's interesting how I was reading one of your recent commentaries, and you kept on saying how it's been blinking. So talk to us a little bit about that and these indicators.
Sure. The background on the Asbury 6, I probably put together the first version of this. We back tested all my favorite tactical tools that I've been using, throughout my career, going back to when I was on the trading floor at the CME. And we tried to find a group of them that would work together as a team, right? Because every indicator is off sometimes. Yeah. So I tried to find 6 that were different enough. And when 1 or 2 were giving me false signals, the other 4 would pick it up. We came up with the Asbury 6. I kept it internal for a long time. I was finding, after doing this for a long time, I was getting faked out by the S&P moves, right? The S&P is down 30 one day, it's down 50 the other. You start to lighten up your long position, even though you like the market, and 4 days later, you're buying fresh highs. So I wanted a way to look at, not stare at the S&P and chase the tail of it, but rather see what's going on internally. So we got 6 indicators here. We've got the rate of change in the S&P, relative performance of stocks and bonds, which we looked at a chart similar to that, investor asset flows in the spider, volatility, trading volume, and breadth. Blinking is when these 6 start moving back and forth between 4 green and 4 red and 3 and 3. What that means is that the market is at a tipping point, in between turning lower or turning higher on a tactical basis. This is all based on tactical tools that we have. This goes back, the chart that we just looked at 10 minutes ago, SPY Ag. SPY Ag is testing that 21-day trend of outperformance by SPY versus Ag. That's telling you this is an inflection point. This is a tactical inflection point. That's what we're seeing here with this balance movement lately in the A6, where we're 3 and 3, or 4 green and 2 red, or 4 red and 2 green. All of these different ways to look at the market from different angles are telling me that either the market picks it up here between now and early next week, and of course we have PCE, which I think is going to light the, it's going to light the firecracker on this thing. But it's telling me that this level right here is tactical. If the market's going to keep going higher into the summer, we should get some acceleration between now and early next week. If we can't, that could tip these charts the other way, and you might see a turn in that SPY Ag chart that we looked at. So a tactical inflection point is what I call this.
Yeah. And, to your point, I think when we were, kind of doing our pre-show huddle, there were more negative than there were positive. So it changed just that quickly in between the time that we chatted. So
it's exactly correct.
Yeah.
Look at these dates. We got 625, 625. That was yesterday. 3 of these turned green yesterday.
Yeah, that's incredible.
Well, when we come back, we're going to get a little bit more into some discussions on the rotation side of things, which John Kosar was telling us has been faster than he's ever seen. So stay tuned. We'll be right back. We're back. It's Justin Nielsen, your host, and Arusha Paris, who joins me almost every week. He's going to be taking a break in a few weeks, though. So brace for it, folks. Brace for it. It's coming. And of course, our special guest this week is John Kosar. We were talking about the Asbury 6 and how that's been blinking. But one of your other models that I really like looking at is your SEAF model, the sector. What is it? Sector ETF
asset flows.
Okay, I'm glad I got that right. So yeah, sector ETF asset flows. And this has also been something that has really been kind of showing, some pretty herky-jerky moves, if you will, and some surprises. We were talking on the show earlier a few weeks ago about how strong utilities were and everything. So why don't you kind of walk us through? These are the 11 sector spiders of the S&P 500. How is it that you look at these, and what are they telling you right now?
We built a model. I built a model years ago that it used to be 10 years ago, these sector rotations lasted longer. They'd last a quarter or two. They don't do that anymore. They're very quick. So I had to figure out a better way to be in the right sectors at the right times that was faster than waiting until you could see the relative performance on the chart. Because by the time you see it on the chart now, the trend is half over. So I started experimenting with measuring the velocity of money moving in and out of those 11 sectors, which together are the S&P 500 effectively, and looking at it in multiple time periods. And we came up with this model. And normally, we got the model back tested to 2018. It's on our website under models. But the norm for this is when the market is in an offensive mode, as it appears to be now. When you look at the S&P 500, you'll see tech at the top. You'll see consumer discretionary at the top. And then you'll see like healthcare and staples at the bottom. For most of this year, really, right after that DC8 date that I was talking about, when everything changed and AI dragged the rest of the market up by its hair, we're seeing rotations where you might have technology is up top, right? It's got a ranking score of 3 because it is number 1 in all 3 time periods, trading, tactical, and strategic. But during the course of the year, technology up at the top 2, like 1 week. The next week, it'll be down at the bottom, and utilities will be up at the top. Right. And then another couple of weeks will transpire, and you'll see the opposite. So it looks like the market is trying to find out, investors collectively are trying to figure out where to be, and they're skittish. They're staying in a place for 1 or 2 weeks, and if it doesn't pan out immediately, they're gone and out somewhere else. So like if you look at sector spiders for the year, there's only 2 that have outperformed the S&P 500 so far. One of those is tech, XLK. That's outperformed by around 4% as of a couple of days ago, but most of that 4% came about a week ago. So it was just really quick. And then XLC services is up a little bit less than 2%. So they're just, the rotation has been fast and furious and frenetic, and there hasn't been, in a normal year, there'll be a couple of sectors. The year's not over yet, so there's plenty of time. But right now, the sector rotation play hasn't yielded much because there's no sustained consensus on where to go. And I think that has to do with interest rates, the situation with interest rates. We have 4 or 5 Fed fund rate cuts at the beginning of the year. Now there are people talking about a hike by the end of the year. We've got a really contentious, presidential election coming up with very different candidates. There's just a lot of cross currents here. We're already up 34% since October of last year. So I think managers just don't know what to do here. Do I take the windfall and maybe start to move into some of the safer places? Or do I ride those 5 stocks until they drop dead and then risk being a little top heavy at the top? So I think there's a lot of consternation here that is not normal to see in sector rotation, and me really studying this for the past 5 to 8 years.
So it almost seems like first it almost seems like those larger cap tech stocks are the safety stocks now, right? And so the money tries to, hey, maybe it's going to go to utilities or materials or some other area, and after a week or two, like maybe not, and they just let's run back home to safety.
Completely, it's like a fire drill. So we run this at the end of the week. We look at it on a Saturday, and it's posted to the website by midday on Saturday. So my son Jack and I, we're always interested this year to see where utilities and tech are going to be, because sometimes they're up at the top, sometimes they're down at the bottom. I've never seen anything like this. There's nothing new under the sun, right? I'm sure this has happened before, but my guess is that this hand-wringing and consternation for the first 6 months is like, it's just how the market goes from trend to sideways to trend again. It's a very the market goes in phases. I think this will eventually lead into a period where we'll be able to get on 1 or 2 sectors and be able to profit from that in the second half. But right now, the market is not ready to make that kind of commitment. That's really obvious in our model.
I wonder how much utilities are benefiting from the whole electricity play, right? That's benefiting from AI, where a lot of institutions, or there are plenty of institutions that are thinking, hey, with AI, it's going to power so much. And I think it uses 10 times more power or 5 times more power than a Google search or whatever. And so we're going to need all this electricity. I wonder how much of an effect that has. That, I don't know how many of those electric stocks or electricity stocks that have gone. There have been some electricity stocks that have gone through the roof this year.
Oh, yeah.
Yes.
And
Yeah.
but I don't know if they're in the XLU. But I wonder if that has caused the utilities to be a little bit more volatile and moving up and down your CEF model even quicker.
The way that I look at that is knowing why doesn't help you make more money. So I mean,
that's true. I 100%.
Sometimes it hurts, right?
Yeah,
Sometimes it steers you wrong.
So for us, we're just following the data, we're following the money. But as an aside from that, there's been a couple of periods this first 5 or 6 months of the year where I saw healthcare up at the top of the heap for 1 or 2 weeks.
Wow.
Didn't stay there long, but it was there. And Staples was there for 1 or 2 weeks. And just like you said, Arusha, it's like, okay, let's try this. And it doesn't work immediately. And they're out of there and they're right back in tech again. So it's almost like, seeing a guy trying to steal a base, right? In baseball, right? He gets off, he gets off, pitcher looks at him, he goes right back to first. That's kind of what we're seeing here.
I like that.
Well, John, we're trend followers here, and you're talking a lot about these trends. So when the trend is so short, what do? How do you make money in that environment?
We stick with our models. CEF model for the past 4 years. First year, I think it outperformed the S&P by 3%. The second year, it outperformed by 22 or 23. The third year, which was the major downtrend, we caught the move in energy, that whole big. If you recall that move, that was basically mid-January to mid-June. The money went there, according to our model, stayed there for 5 months. So we outperformed by 27 or 28%. Last year, we were relative performance. We were dead even with the S&P. So I think if you're using a model and you're comfortable with it, especially you're comfortable with the risk parameters, your betas are right, and your maximum drawdowns are something that you're comfortable with, you can't. If you start trading your own model, you're not going to make any money. You do the work to back test your model and understand that you're not going to have a nirvana kind of an environment all the time where your model is going to flourish. Right. The game is over time. How does this thing do over time? And we've got a couple of 2-3 different models. We blend them together and we back test them as sets where you might be 30% in this model and 70% in that one. See what the risk reward numbers look like that, and we blend them for clients. And I'm a lot more comfortable than trying to chase the tail of the S&P 500. I find things that have worked over a 5 to 7 year time period, and we stick with them and understand that as the market goes through its different cycles, sometimes it's in an uptrend, sometimes it's in a downtrend, sometimes it's sideways. Over time, by making logical, data-driven decisions, I think that's the only way to play this game. I really do.
Yeah, I mean, I think that's actually just like, even from a bigger picture and conceptual kind of view, I think what you said is very important. You did your back testing, you did your studies, you found out something that worked for you, and you're sticking with that. Much like we have our own view and we have our own methodology and we stick with that. And in the end, as Justin mentioned earlier, we'll kind of end up in the same conclusion, but maybe we've taken different paths to it. So it's that consistency, and especially once you find something that works. A lot of people will just kind of go from strategy to strategy to strategy, and they never kind of develop that expertise to develop the sensitivity how markets can change and adapt in different environments.
Yeah, I think a parallel to that is when you look at investor sentiment, right? Investor sentiment is really bullish at the top.
Yes.
And then it's a fire drill to get out. And then it's really bearish at the bottom, and that's where the opportunities lie. I think human nature drive these markets. How we react to fear and greed as a huge group of investors together, those are the buttons that are in our DNA, right? We're either really fearful or we're really greedy. And people tend to ditch a strategy You might be in a different period like this. This has been a pretty unusual 6 months. They'll say, well, I'm not going to use this anymore. It's kind of like when you throw in the towel at the bottom, right?
Right.
And then you're saying, oh man, now what do I do? And so whenever you let the market push your buttons like that, I think you're dead meat. I think you really need to have a strategy that has to do with data, has to do how something has responded to the market over the past 5 to 7 years. This past 5 to 7 years have been great, right? We've had a pandemic. We've had a major uptrend. We've had a major downtrend. We've had a shift from a zero interest rate policy back to a little bit more normalized interest rate. There's a lot of stuff that's happened in the past 7 years. It's a great chunk of data to use for a back test.
Yeah.
Mm-hmm. Yeah. You have another way of looking at some of these sectors that I wanted to kind of have you share with our listeners, and that is kind of what you call the rainbow charts. So I'm going to pull. We can pull up the XLK right now, which, as you mentioned, has been the best performing sector spider fund of the year so far. So how do you use this rainbow chart to kind of tell you what's happening here?
This is a component of our CEF model, which is a part of our services that we offer. And we also, we manage money with this model. But we had the chart, kept it internal for a while. I wanted to be able to look back a year and just see the relationship between what the model is telling us and what the market's doing. So what we have on top, favored is green and neutral is yellow and avoid is red. And down at the bottom, this is XLK. Up at the top, down at the bottom is a corresponding relative performance chart between XLK and SPY. So you can see on May 15th here, the last quarter of the chart on the right, on May 15th, it moved into favored status. It got stronger, and then it had a quick dive here into neutral on June the 4th, and then it quickly came right back up again. So during that period, since May 15th, we've had 4% of relative outperformance in XLK. That's what we're looking for. But what's been odd this year, take a look at this dive from basically, looks like the middle of March, and then we collapse all the way down into a void, the weakest that we could have, which would be a ranking of 33. That's the lowest it can go. And then and look what happened in the meantime. We had relative underperformance here. And then as soon as we bottomed out here on a void and started to move higher, we had an even bigger move up. But these types of choppiness is something that you don't normally see. What you'll normally see is like what we have here from October of last year to roughly December of last year. We had this sustained period. This is about a third through the chart up top, where it was up in the green and stayed there, and it gave us this big move. So all we're doing here, we're not predicting, we're not trying to forecast where the economy is going to go. We're chasing the money, and when the money finds a place that it likes, it stays. You get one or two of those sustained moves every year, like we had in energy, during the major downtrend, and those make your year. Is finding those places where the money goes and the money sticks, and this shows us kind of what it's doing.
Yeah. Let's go ahead and show one more before we take a break. You gave us a few to choose from. Utilities, real estate. Which one would you prefer?
Let's look at utilities because it's been kind of unique also.
Okay, perfect.
So here we've got utilities, which if you look up top here, it's in favored status as of April the 30th. And we had some relative outperformance here. Now it's been about a relative performer really since April the 30th. Maybe down a touch, but note that it's got the best CEF ranking here that it's had all year. That's kind of interesting to me. Highest it's been all year, the best ranking that utilities has had. Another interesting takeaway on this one is look at from January, which is right dead in the middle of the chart when it dropped into a void. It stayed in a void. It popped into neutral a couple of times, but it stayed into a void for a pretty good period of time, and it gave us a nice period of relative underperformance underneath. So this is, for the managers that work with us, this not only tells us where to be, but it tells us where not to be. Right. So they may look at CEF and say, okay, we're, here's the stocks that we're holding in our portfolio. we've got staples and XLU on a void. So let's see which stocks we have, or let's see what those charts look like. Let's see if you may want to pare back on those because the money is coming out of those to go in other places.
Mm-hmm.
And this one's so much steadier than the XLK, right?
Right.
Which is
As opposed to the EKG, you know?
Yes, exactly.
Right. Yeah, this is choppy too. I mean, they're usually more stable than this. I mean, there's been a lot of chop here. If you look from September, look at the fourth quarter. It's in and out and in and out. So, but they help me to see these trends as they're, the data is nice to see, but it helps me to visualize what the ranking is and what the market's doing about it. Sometimes it reacts really strongly, sometimes not so much because there's other factors, obviously, than just this. You know, there's, interest rates, and economics, and there's a lot of different things that are making the markets move. But I think one of the most important ones is where's the money going? And that's what this shows.
Yeah. Well, when we come back, we're going to get John's thoughts on a few individual stocks and wrap up this show. So stay tuned. We'll be right back. We're back. It's Justin Nielsen here, along with Arusha Piras and our special guest, John Kosar from Asbury Research. He is the chief market strategist there and a frequent guest that we've had on a number of times. He's got great stuff. So, John, let's kind of dive back into the market a little bit. When we're looking for actionable things, it's no question that the NASDAQ composite, the NASDAQ 100, those have been kind of the indexes to watch. As you said, technology's been one of the big areas. So maybe we could throw up this chart that you provided on, QQQ and how the assets have changed there to kind of, tell us a little bit about why you're choosing the stocks that you're choosing.
Sure. I mentioned earlier, we looked at SPY versus AGG. And we pointed out that there was an inflection point there on a 21-day basis, which is, again, that's our tactical time period here at Asbury. This is NDX up on top, and underneath is the QQQ AUM daily with the 21-day moving average. So nobody knows what the future is going to be. I mean, I've found out after 40 years, I have no idea what the future is going to be. So
when's the next brownout, right?
That's right. That I can tell you. So the next best thing is if you can find these inflection areas where you've got some risk reward and the market's kind of backed into a corner and it has to do one thing or another. So that's what the SPY Ag chart showed. And this has given us the same setup, but a completely different indicator, right? So we've got the Qs. We're above the 21-day moving average from Jan 8th to April 9th, and that gave us that nice move up in the first half of the chart. It dove down below it from April 10 to May 2, about 3 weeks, and then it re-engaged that trend on May the 3rd. Look what happened on June the 4th. It came down and tested the average, and within a couple of days, we had a flush of new money coming into the Qs. It took it off the average in the lower panel, and it gave us a really good place to put additional money to work or to put a, whatever position on. Here we had risk reward because we knew if it goes to the 21-day average on the bottom part of the chart, we're out because now we're in monthly contraction. We're at that same place now. As of, and I'm going to get, the data in a couple of hours, and we'll see what happened today. But we're right at the same place now. So if we see those assets start to expand again, this is another place that might turn into a tactical bottom, just like we had in the beginning of June. If it fails, we really didn't risk very much. Like we risked just a little bit here to catch that move up to the recent highs. So what does all that tell me? It tells me, well, the market's been quiet all week. Why? It's waiting for PCE. That's the Fed's favorite inflation gauge. So that's the trigger that's going to, I think, start the next move. But what this tells us is that we have some risk reward here. If there's going to be another leg higher, and the next two charts are going to address that. But if there's going to be another leg higher, according to the asset flows going into the Qs, this is an inflection point on a tactical basis.
Makes sense. So one of the first stocks that you wanted to cover is Microsoft. So certainly, Microsoft NVIDIA, Apple, they're all vying for, that number one spot as the biggest market cap, company out there. And what is it that you're seeing on Microsoft? It certainly has a lot of sway on the NASDAQ 100. Is this potentially actionable here, or how would you handle it?
Yeah, Microsoft, NVIDIA, Google, Amazon, I think.
Mm-hmm.
The top five in market cap in the S&P 500 are about 31% of the market cap of the entire index. It's just, those are really big. So understanding the way the market's moving now, there's a handful of mega cap AI related stocks that are really driving the bus. I've been looking for patterns on these to try to answer the question that everybody has. How much farther can this thing go, right? That's what everybody wants to know. So we had a technical pattern here. It's called an ascending triangle. It's basically the market's been trying to get up through the September 28 highs for a while. And in the meantime, the bottoms are rising, right? So, the demand is getting better, but it's holding those old highs. So we had a breakout on June the 3rd. Again, we don't know what's going to happen in the future, but this breakout, as long as we stay up above the upper edge of the pattern here at 430.82, it targets 473. And 473 is 5 to 7% higher than where Microsoft is right now. So that tells me back of the envelope, as long as we hold 431-ish in Microsoft, there's the potential. And July is a pretty good month seasonally. I mean, it's not super strong, but it is a rebound from June. This tells me that we can have some legs here. Again, a lot's going to happen. A lot's going to depend on what happens on Friday, with PCE, tactical point, but this tells me that this can potentially go another 5 to 7% higher. And the linear correlation between Microsoft and the S&P 500 has been up in the 0.8, 0.9 area for 35 or 40 years. So they're very closely related to each other. So do they drift? Sure. But generally speaking, as goes Microsoft, thus goes the market.
Yep.
Mm-hmm. And I just real quick, I think you said the breakout was June 3rd, but your chart shows June 11th, and that's what I'm kind of showing. Just want to make sure that in case people go back and look at the chart, it's June 11th that you were looking at, right?
That was a typo with my mouth. Yes.
Okay, very good.
June 11th. Yes.
And I should have also disclosed that I do have a position myself in Microsoft. So, that's really interesting stuff. Maybe we can move on, or
sure.
Arish, did you have anything to add there?
No, I know. I mean, it looks like a solid breakout. That 473 target. It's not exact. Usually, when we're looking at it through the IBD methodology, we're looking for around like 20% or so, which might be a little bit higher. But I think that 473 is definitely a reasonable one. Just using I'm assuming you're just using kind of the measured move from the triangle.
Very simple like that. And again, it's not set in stone, but it gives me some parameters. If we go through 431, we're probably done on the upside, right? Because you've collapsed back into the pattern. So it gives me some back of the envelope stuff to watch.
It's perfect.
Yeah, absolutely. Let's go ahead and take a look at Apple. And I also do have a position in this one.
As do I. Yep.
Kind of looks has some similarities, and Apple. It was interesting because this really wasn't participating, for a while there, and then of course they had their developers conference. They used that key phrase AI, and wow, things changed.
Yes, there was a lot of important stuff that happened on June the 11th. Actually, we looked it up here. I don't have it at the top of memory, but this was generated by some important information that came out from Apple. But the sense of the chart is the same, right? So we got up to the highs back in July of last year, and then we went sideways. That means indecision, right? Nobody wants to buy that new high because it's too scary for them. Well, that changed when that information came out, when that news came out on June the 11th. Again, very simple, technical analysis 101 stuff, right? You take the width of the pattern, you stack it on top. We know the breakout was 178.51. That's the high from July of 2023. Targets have moved to 230. That is also about 5 to 7% higher. So as long as we stay up above 178.51, this June 11 move is the re-engagement of the trend that started back in January. And we're okay because we know this has so much sway. That's one advantage maybe that this odd market has, is there's a handful of stocks that are driving the bus. So if we get these stocks right and we've got some patterns to lean on, there's an element of safety there. So we know if we go through 178, now I'm starting to look at my Asbury 6 to see what the internals look like. I'm starting to look at the asset flows in the queues to see if everyone's getting out of the pool. So these gives us some benchmarks where if these big mastodons are going to keep dragging the rest of the market up, we have some expectations up and some levels that we can use as fail safes on the way down.
Yeah, and that was a powerful breakout past that resistance area, that 178 resistance. So it didn't just open the door at that time. It knocked the door down.
Right.
Let's see how that works. But a lot of times you want to see something like that when it breaks out like that.
Yeah, took a battering ram to that door. And, it's interesting that you mentioned that June 11th date, such an important one for both Microsoft and Apple. One of the big pieces of news was a partnership where Apple is going to be using iOS, 18.
That's right.
With ChatGPT, OpenAI, partnering with Microsoft. So again, now you've got two big behemoths that are kind of be, I don't know, Wonder Twin Powers activate type thing. We'll see what happens. For those of you that remember the Super Friends back in the day. So very, very, very good stuff. So John, before we let you go, again, you're always so kind enough to share, a lot of your charts and stuff like that. Where should folks go follow you on Twitter or go to your website to kind of get more information?
Two places that they're both pretty easy. The first one is you can go to the Asbury Research YouTube channel. There's a lot of videos there. There's a lot of videos that I've done on the media. There's a lot of our own stuff that we put up there that'll give you a little bit more information. We have an unusual way of looking at markets that I've kind of developed over the years. We're not so much looking at the MACDs and the stochastics, but we've kind of developed our own tools. The other place is asburyresearch.com. Contact tab. If you're interested in getting more information about our services, again, we supply research and we also manage money. You could go there and give us your name and email, and we'll send you an email back that will give you a little bit more information if you want to open up a dialogue with us.
Great. Well, hey, John, thanks a lot for coming on the show again. It's always great to have you. Go get yourself some brownies. You deserve it.
It's always fun to hang out with you guys. Thanks.
Okay, take care. That's going to wrap up our show for this week. Next week starts a long Arusha drought. We're going to have a few weeks without Arusha. But don't worry, we've got Mike Webster that's going to be coming on the show. So he's going to join me, and we're going to see how much we can chat about Arusha behind his back. So hope you join us for that. Thanks a lot for watching this time around. We'll see you next time.